The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour. This is Monday, July the 13th. And thank you to all our hosts. Good to have Tom back, and we're on board. Everybody's here. Most importantly, we're looking at the Greek result, the market perception, the market action. And the market action says we like what we hear. We're up 200 in the Dow at 17,960. S&P is up 20 at 2096. The comp index is up 63 at 5061. You've got gold down 5 at 1152, silver down 8 cents at 15.40. That's because the dollar's having a good day. Dollar's up 71 cents at 96.88. And bonds are down just a fraction, down a penny. That's very interesting because the TLT is down a little bit more. It's down 20 cents. It was down earlier on. I think that 114.80 area on the weekly TLT, that's the Lehman 20-year T-bond fund, is going to be really important to watch. Why? Because if there's a breakdown and the TLT starts to go underneath 113 to 112 key support, that's way underneath the 114.80 200-period exponential moving average, that would suggest that money is coming out of the bonds. And where will it go? It'll probably go into stocks. Now, what we're seeing here, I learned a long time ago not to dismiss coming off a base, a low point, especially if it's a cluster formation that's trying to build something that can't break down, but instead it won't break out until it's had about 3, 4, 5 bars, that is entire candles, depends on what time frame, but it's the same thing, one after the other, and then it breaks out. That breakout, especially if the MACD and the stochastic are positive, says don't dismiss this, because there's a chance that you could go higher unless two things happen. The first is, now let's look at this here, right here. This is what I show my subscribers to my opening call every day. And I'll talk about a note that I got from someone in a moment over the weekend, and I'll go into that. Basically what it says is that within this context of coming off a low, that's 17,465, what you've seen is the MACD cross positive, but the histogram is only just now squeaking to over the 0% line. It's very important that it starts to move over that 0% line and stays above. And the stochastic has a positive divergence in that the low that was made at the trough F in the Dow back on the 30th of June at 17,576 saw the stochastic underneath the 20-period, underneath the 20% line. But the much lower low, not much, well, low enough, 17,465 low of the 7th of July saw the stochastic rallying, and that became a positive divergence. First of all, I never ignore those positive divergences if there is a move, a strong move in the direction that would turn those indices positive, and there's a good price movement in whatever we're following. That's occurred. Day's young, not even 2 hours into the first day of the trading week, let alone the trading day. So when I look at this, I have to say to myself, okay, now I get to the letter. And the letter says, hey, you've been calling for a long time. Basically, this is what the letter said. You've been calling for a long time for a consolidation and a break below 17,500. And yet we haven't broken 17,500 level. We just broke it once intraday to 17,465. I look at this and I say, why don't you talk about it as if you had missed the call? Gee, I don't know how many times I've said this. I'll say it again. I had spoken about it. I had a special workshop dedicated right to that very thing. And during the workshop, I kept saying that there's a possibility that we use time and not price. And although I thought that there was a much better chance that we would break 17,500 to start testing 17,000, we've got to be prepared that the pattern that had formed back in 2010, when I recognized that the monthly chart, let me just see if I can pull one of these things up. Yeah, I'll pull this one up, just to show what I'm talking about. The Powell move from the March low saw 2010 right there, that was the first and only big pullback we had all the way from the low of 64.69 in March of 2009. And at the same time, what I'd been talking about was that there was a chance that summer that we could see a rotational correction keep the price buoyant, while at the same time, areas that had become somewhat overbought rested, and areas that were not even recognized as being in a buy mode suddenly became on strong and had a pretty decent rally. That's number one. Number two is the very big correction, 20 to 22% correction that we had from the May high back in 2011 at 12,876 did see a 10,000 to 404 decline. That's a 2,400 point decline, 20%. And at the same time, ever since then, we've had nothing like it in corrections. And one of my contentions has been that there is a chance that, I'd say this in February, that in the first quarter, we would see some kind of a top and have a pretty sharp pullback. Well, in the first quarter, we went to a peak we went to a peak F/B at 18,288, and then just pulled back a little bit, used up some time, but nothing in points. Another reason why I thought that the next very sharp pullback could be the one. But at the same time, look at this. And one of the reasons why I've tried to make it a big emphasis to say that this market has been full of rotational corrections, and that even within sectors, we see, even now, we're seeing fewer and fewer of the leaders of each sector lead the market higher. I also said that the correction, very much in a way, it looks a little bit like the 1994 sideways correction. And this is something that I've taken into account. And it's one of the reasons why we've been short in my opening call, short a lot, taking quite nice profits actually in positions. And just being through attrition, we're now in a situation, I can't check right now, but maybe we don't have more than, I'm not sure if we even have one short at this particular time. We tried to get some longs today, didn't work. But that means that I'm just using money management to control the things that we can't control, and that is how sharply a move occurs and how sharply a move up or down occurs, and how you can ameliorate any losses by raising your stops or buy stops, or you can have maybe smaller gains, but that's how you can get out of positions. And then you can reassess, and we're in the reassessment situation right now. Did I want to add any shorts today? No, I want to talk about this again. Off lows, look at this low of the 2nd of February at 17,034 in the Dow. You see that sharp move up, almost a gap? Let me just double check here because there's a lot going on. 17,367.68, 17,369. So there's a gap up that has not been filled yet from that February the 3rd rally in the Dow. Look at the candle. See these two strong candles, and then a doji candle, another strong candle. We've seen that pattern. We had seen that pattern many times before. I don't know if I've got enough room yet to show it. No, okay, I don't want to change the chart patterns at this particular point. I mean, the look back period. This is fine. You see that sharp move? Two candles and another one goes straight up. It goes from 17,067 back in December, around about the 16th, and woof, all the way to the 26th of December, goes to 18,103, and then fails and makes that top at 18,103. So I do not want to get in too early by going to the short side. Probably I made a mistake this morning. I should have immediately said, hey, wait a minute. This is acting really well. I'd like to get back in on the upside. And if there is a very strong candle, buying at the open today would be a good thing, because there could be a rally into mid-session Tuesday. All right, I didn't do that because we were handling other positions. Now let's look at this. When I'm looking at the, and let me just tell subscribers, the chart, the final chart did go out. We're now a little bit late. I apologize for that. I thought I had sent it out. Then I had an appointment. When I got back, I got messages all over the show saying, hey, where's your Trader's Corner? I sent it out. But all the parameters that we had for Friday, those are the same ones. I wouldn't have changed those. So I don't think anything changed, other than we missed the 2 buy signals, not because you got it late, but because they gapped up and I was not prepared to buy a gap up. Okay, now let's look at this in terms of the context of the intra-day work on Friday. We had stopped right there. And then it said, look, you've made 2 arch formations in the 120-minute chart. This is my overview and to market today section in my opening call. And what I had said is that we had those big spirals to the upside based on the Chapman wave trend gauge, where you went to 2.47, then 2.29, then 3.42 on 3 consecutive sessions. And I haven't seen that before. Well, not for a very long time. I couldn't find it. Must be there somewhere, but certainly not for the past few years. You've had it over 4 days, but not 3 consecutive levels in the short-term trading index up in the mid to high 2s. Now here's the other thing. On Thursday we got on Thursday we got a reading of 0.21, very low, and that wasn't even options expiration. Theoretically, that would have said that we should get a sharp pullback in the market that took the Dow, whether the futures were up or not, to a negative position. Whether it was a -1 or -100, it would take you negative before a rally could unfold. That's the first miss in the short-term trading index that I can recall in at least 2 years, a direct miss like that. There was another one where the market had that indication, and then there was a very sharp opening move in the Dow, and it kept going higher. Then out of the blue, it dropped from 180, I think it was, to a +35, and then closed at about a +50. So that kind of could count, but I don't. I'm very strict. It did not go negative. It gave everything about a rug pull, but it did not go negative. However, on Friday, it was just a big move to the upside, and it stayed higher. Even though there was a pullback, it stood sharply higher. Today, I got the same reading on Friday, so today should have seen the rug pull. We might have seen it last night, where the futures were down 11 points at one stage and then came back strongly. I'll talk about that in a moment. Basil Chapman, Tiger Technicians Hour. Dow's up 180, S&P's up 17. We'll be right back, and I'll talk about a webinar coming up in a week.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman wave sequence. Using the Chapman wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks, we're back. So now I wanted to go through this. So look at the volatility index. It went to, you remember in the Chapman wave, you look for the most identifiable lowest low bar, and then you want to go to at least a D, and that's where you got to start being careful. And the VIX index, D and E, are where you usually pull back sharply. Lo and behold, the 120-minute chart went to 20.05 on Thursday, and then pulled back very sharply. It's gone from the 20.05 way down to the 14.44. That's 6 points. That is huge. That is huge. That is 38% or something like that, 40%. That's a huge move. So that tells me now, that means I can go to the weekly chart, and I can show you right here that the VIX index starting off the week with this gap down, it's very interesting. It's almost like there's a gap. Let me just check that. 1539 was the low and 1536 is the high. There is actually an island reversal in the VIX index, which is very unusual as a pattern. Intraday, yes, or over 2 days, but over a 2-week period, this is something. So that means I've got to watch real closely to see where the volatility index closes on Friday, because at this particular point it's suggesting this rally could have a little bit more to the upside. Okay, so now I said there are a couple of things that we're looking at. Let me talk again to a couple of issues here. The Chapman wave trend gauge said that we should slip to a minus this morning. It did that in the futures, but it hasn't done that in real life. So this could be 2 consecutive misses in this particular index. Yes, it is news related, but you know what? You can't put a little note here saying Greeks or whatever. You could do that in the VIX index, but not here in the trend. So this is something that says that was two misses, first not just one, but two misses in a row. Yes, it was outside influence, but the facts are the facts. Days young, we could still close down. Who knows? But at this particular point, I'm saying I've got to be as functionally accurate as possible. And so this says watch that index because it started to make mistakes, and it's done that twice in a row. However, it's been an absolutely marvelous indicator. Let's get out of that, and we want to go to a couple of things. I wanted to quickly look at, it doesn't have to be quick, I said quickly because I have questions in the den that I will get to. Here, let me update this. This is the Dow, this is that single leg A up, and we've got to be very careful because these tend to fail unless a whole bunch of things happen. At this particular point, the technicals are way better than they were in the stochastic back at the low that was made at 17,698, and the MACD is lower. So there's a kind of a divergence there, and it says MACD trying to cross positive. We're going to be watching this real closely, but none of this really matters. It's the weekly that counts. And the weekly says, I've had lower lows and lower highs recently, but I've held that up channel. Remember, I spoke about this last week, up channel key support. Not only have I held the support, it's been a trigger for a gap to the upside. Oh, what was I looking at a moment ago that had gaps? And I was going to say gaps like this are very unusual. Well, gaps are very unusual in weekly charts because it has to happen on a Monday. And this happens on a Monday, Friday, and now we've gapped up even higher. And it's above the 9-period exponential moving average. And if you look at the weekly chart, monthly chart, let me show you the monthly chart. Monthly chart has held so far very nicely that 9-period moving average of 17,677. So I'm going to be following this really closely. What is my bias? My bias based on the chart formations, a whole bunch of things says that this is a counter trend rally. We should not make a new all-time high. It's an answer to a question in the den. We should fail underneath 18,351, but there could be, because we've already had a move going from the 17,490s to a high today. That's 17,004. That's about almost a 500-point rally in just the shortest period of time. In fact, in 1, 2, 3, 4, it's not so short, it's 5 days. It feels short, but that choppiness really took away a bunch of energy. So we're going to be looking at this closely. Why? Because by Wednesday, if there is a doji candle, say tomorrow, but on Wednesday we don't pull back sharply, in fact, you move to the upside and you go into the 18,050 to 18,000, 18,050 to the 18,090 area, all of a sudden what you've done is you've created a pattern that says, let me just show you something here. I haven't joined it in this one, but I will. It takes this moving average it takes this trend line right here, and it takes it to this point and says, hey, if by Tuesday or Wednesday, the Dow is trading the 18,050s, you've broken a trend line resistance that would have been very important under other circumstances. But it's even more important now because it's under a period of duress. And if all of a sudden you're looking at a breakout, it says the next level on the left that it's very easy to look at, because if it gets taken out, at that point you can start saying, hey, maybe we will test the highs. And that's the 18,188 high of the 23rd of June in the Dow. Basil Chapman, I'll be right back. I'm going to talk a little bit more and about the webinar coming up.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They've been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We're back. Dow's up 195 and S&P's up 20. Now, on the front page of TFN, you'll see it says, Basil Chapman follows up on his popular 1920s webinars. Join Basil Chapman for an hour-long webinar where he follows up on his 2 previous webinars showing the matches between the 1920s and today. This is Monday, July the 20th at 5:30 for an hour. Now, what's really important about this particular one, and it's going to be a little different to the others in that I want to spend quite a bit more time on the technicals as they relate to that period and the technicals as they relate to this period. And what's going to be really important, we'll have a week to see how the trading range unfolds this week, because the 2 scenarios have to be, one is this is all news related, and at some point there's going to be a rug pull, and at 17,500 level support goes. And what is important about that, it means, let me just show you something here. It means that in the Dow, INDU, the key support level that has been maintaining this trading range has been broken. If that happens, if we start trading closing in 17,400s for a couple of days, and it means that that left side bar that we're looking at, that spectacular bar I showed you just a little while ago, back on the week of this first week of February, has a low of 17,037, and that's the only support there is on the left side. That's how you gauge support. You look to the left, you look to the right, see where's resistance, where's support. and that makes it very important. That was another question. And what's the big deal? All of a sudden, you're holding and you don't talk about it anymore. Well, I can only talk about what happens, and we have not closed under 17,500, and that's why it's so important. And not only that, there are very few techniques that I know of, other than the way the Chapman wave methodology has been unfolding, that has really over the past, since December of last year, said that the upside is limited, but the downside is going to be either time and price. And that's the way it has. Look at this arch formation. Even with today's action, I could even raise this a little bit. That could take you to Dow 18,088. That's what I'm saying. That's going to be such a critical level. And why do the levels change? Because every time there's a different trend line, look at this trend line here in the Dow. It's saying that a close on the daily above 18,050s opens it up to test the left side high of 18,188. That's how I look at trend line support. That's what I've done for decades. That's the way I do the analysis. Here's the other thing. In the monthly chart, why is the 17,500 level so important? Why? Because in the Dow, you've walked the 9-period exponential moving average. What a beautiful technique that is. Probably I should still be just holding long that Dow diamonds that we bought at 66.50, I think it was, back on March the 6th. In 2009, probably should still be holding the darn thing instead of trading. Well, we don't, and we did take a huge profit in that later on. But we that's one of those things that happens. But look how it's walked the 9-period exponential moving average. It hasn't closed underneath there. It's closed under once since it broke out on the week of October the 30th. No, on October the 30th. Let me do this again. October of 2011. It broke above the 9-period moving average, and only once did it close under it. Closed on it once, there it is, twice, 3 times. So we're starting to see a little acceleration. That's another thing that tells me that 9-period moving average of 17,680 in the monthly chart is so critical. Therefore, the 17,500 break on the downside clearly says you're now away from that 9-period moving average. Look at the way the MACD is turning down. Look at the way the stochastic is at 81% as is making lower lows as the market was trying to make higher highs, and then it went to 18,351, snuck above there. But look at the limited upside it's had. So either this is going to be a high-level consolidation. I spoke about 1994. Let me see if I can get that right here. 1994. 1994, right there. So 1994, right there, we went to a top at 4,002 in January of 1994, pull back to the 3520 level, 500 points. Let me just double check. Yeah, I'm sorry, yep, 500 points. And my thinking at the time was it's exactly the level that I was expecting. I remember being with one of the Fidelity fund managers, and I already predicted that we would go down to that level. Well, we got to the level. I remember meeting just after that and saying, I think we're going to do a retest of that before we can go higher. I see us going higher, but I'm thinking we could retest. Well, you know what? We didn't do a retest of the low of 3520. The lowest we got to was right 612, and then it just months later, and then it just zoomed higher. Now, I can't see us having the same thing. This is a completely different time to 1994, but the chart pattern says that's the reason why I spoke about a sideways consolidation, because you cannot ignore in a market like this that the Fed has been there supporting. They're not quite there supporting in the same way anymore, but they're still there. Most importantly, what we're looking at is that the struggle of those candles to break out decisively is very obvious. This candle, right as we're speaking, is a very positive candle compared to where we were at the close of June on the last day, but the month isn't even close to being over. What if we close July at about 17,000, between 17,700 and 17,500? That's saying that the upside had an opportunity with this whole Greek, the so-called resolution. It's just not a resolution, but so-called resolution. And China, I was asked about the China market. Let me just get to it. The China market, the FXI, is struggling. It's right at the 9-period exponential moving average. This is after China said 5% of the stocks you own, you're not allowed to sell for what it was, 6 months or something. I don't know what it is, for a whole period of time. That's number one. Number two is, we are watching you. We're watching you. So what does that say? It says that the wick of this candle at some point, see I drew the arch formation, will get tested. And it'll get tested because it isn't that people are selling, but maybe people aren't buying. And China's going to find out in the market that the market is bigger than it's bigger than even governments, except when the government is the United States and they are prepared to put in as much money to keep it afloat as possible. Maybe that's what China will do, but at this particular point, just banning something, we saw that. You remember when they banned shorting? They banned shorting of the bank stocks, I think it was, 2008, and it still went lower. All right? So it just doesn't work in a capitalist society that an external, in this case, the government, can come in and dictate what's going on. But it can if it's going to actually be the person who's holding the purse strings, not the person dictating trends, but the actual purse strings, as the Fed had been when they started to loosen up the money. Okay, so that's the FXI, but look at the difference here. The Dow Jones Shanghai market has a little different pattern in that the candle today is way stronger. It's above the 9-period moving average, and that says to me Shanghai could go all the way to, it's at 524. I suspect that this candle right here with a high of, no, the candle right, where did it go? Right, the candle right there, with a high of 552 and a low of 512, somewhere inside there. That's where it should stop, at this moving average right here. This moving average is the exponential 21-day moving average, and it's at 555. So I suspect that the levels to watch will be 533 to 535, and then 548 to 555 on the Dow Jones Shanghai Composite Index. And now let's do something else. So that's what the answer is. That's the level I'd be looking. It could even, if this rally is this week into Wednesday or Thursday, then you could see this market go all the way to the 9-period exponential moving average of 563 in the weekly chart. But in the meantime, there is some upward bias, number one. Number two is the pattern that I'm looking at in the monthly and the weekly. And let me just show the FXI, because that gives a better monthly, because that actually went to a peak E. And it showed you, I remember I looked at this the other day, and I showed you that inside track repellent zone. And I'll draw this in. There's no need to draw it right now, but there will be a support zone. And at this particular point, it looks very much like this rally can go a little longer, and then it's going to arch over and come and test the wick. And that wick says a close of the FXI, a close under in the daily chart will impact the weekly chart if there is a close under 41.50. And it's at 42.94 right now. So let me just show you something else. I want you to go to, yes, I wanted to show you, I want to move around a little bit. I want to show you bonds. The bonds are in this up channel. They've just gone. This is a major, major up channel. This is about a 20. I can't tell you anymore. Oh, I can. I can tell you how long that is because I've got the opposite. I've got the mirror image, which is the TYX. So the TYX is saying that's the 30-year Treasury bond interest rate. This is the yield. And it's saying that this major down channel that it's been in since the high of October of 1987, some of us remember that very well, the high of 1987, that repellent line says that if, now let me open it up, that if there is a close in the yield above 39, let's call it 40, 39.76 was the high of the 1st of January, in January of 2014. If there is a close above that, we're in a different environment altogether. There's a change of environment. Okay, let me show you something else here. This is the weekly chart of the yields. This is the 30-year in white, and it made a peak E at 32.55. Normally, these peak E's have been ready for a sharp down move. Once in a while, it'll still go to an F. It'll go to an F, and in this case, it went to even a G. That cluster formation over a period of about 7 weeks. So we're going to be watching this real closely because any move, doesn't have to be a close, any move of about 32.55, 3.255%, and all of a sudden you've got a leg F, which could have been a recycle, but I call it a leg F in the 30-year. This is the 10-year note yield, peak D, and this is the 5-year note, T-note yield, and that's only at C. So let me get out of this, and I want to show you something else. Another reason why I'm kind of concerned here is that wood, which is the iShares of the global timber and forestry ETF, has been making lower lows and lower highs, and it's down and below the up channel, this intermediate term up channel, which started back a year ago. I'm sorry, it started 2 years ago, June, July of 2013. Broke it once and then went above it. And now it's on its way back to breaking that key support level, and we're going to be watching this very closely. And it's saying that, in fact, there's some weakness internationally in the buying of these products. Now, the home sector, the housing sector, has made a cup with a potential cup and handle. Not one of my favorite patterns. Why? Not because it doesn't work. It's just that when it does work, by the time it works, you needed other techniques to get you into the stock. Well, we haven't gone long the HGX, and maybe it's something to look at, but this is a pattern that says the candle that we're looking at right now probably shouldn't be happening, breaking out to recovery highs here, not above the 238 peak F high, 238.32 of the week of the 10th of April, but it has gone to 237.31, and this week is already at 236.90. Oh, it hasn't broken out. So this is going to be really interesting to watch, because if there's a break to the downside under 224 in the next 3 weeks without going above 238.32, that's going to suggest that the housing sector is in trouble. And now let's look at the housing sector. We get out of this right here. There we go. And we'll look at TOL, TOL. Nice move to the upside. Peak A, B, C, D. Recycle. Okay, this is still acting very well. And if at 39.02, up 15 cents, if Toll Brothers is able to take out 39.50, that's only 50 cents higher, it says it should make a cup formation and retest the previous high back in April of 40.33, and that monthly will be a recycle. It will be either F/B, F or B. And we'll see how the technicals are holding up here. But so far, it's acting very well. Lennar's the other one. Now, Lennar and Toll had been leaders. Lennar is a little stronger than Toll because it's made new recovery highs. So in the weekly chart, I have to call that C. It could be a recycle, but I don't want to be safe and call it C and E in the monthly. So Lennar is still acting quite well. It doesn't say that it should break out decisively, but it is suggesting that it could get to the 54s, and it might need just a little bit of a breather here. So that's Lennar. Okay, now, a couple of things. Oh, a question about Wayfair. Yeah, it's one that I really love. I was thinking of getting it for today, for the opening call, but there was just so much going on, so many things to look at, so many charts that I sent out that I did notice acting quite well. Look, it's up 146 at 38.81. I think it's going to break to a new recovery, a new all-time high, about 39.43. I'll be right back.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at directionshares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartley's, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Hi, folks. So let's do this. I'm going to explain to you the types of studies that I'm doing here that I will be discussing in my webinar coming up a week from tonight at 5:30, Monday the 20th. And it's for subscribers only. And let me show you something. The New York Stock Exchange, great move up 0.73% today at 10,932. But the 10,975 to 11,050 area is going to be very strong resistance. Now, the one thing that's really important about this is that it's gone to a peak C. The only way I can really count it, I've looked at so many different ways, is to say that the monthly is a peak C. Does it go to a D in this particular phase of the summer and then have a sharp decline? I don't know if I can do that. I can say that right at this particular point because the MACD and stochastic are really very weak in every time frame except the daily is just turning up, but it's still not a very strong one. It could be strong if it continues rallying. because there was a positive divergence. So let me do it this way. What I'll be discussing is the link between the socioeconomic, political, the connotations that I see there as they relate to the markets. I still don't feel any different to when I was saying earlier on, you can take something off to lighten up a little bit. And if the market goes higher, you're participating. Don't be afraid to take some short positions that we've done. We've done some really nicely. We have one that's still working. I forgot. We got a little bit left. It's short. The semiconductor index took some really nice gains, 20-something, 22 and 30%, I think it was. And we're short all the way from over there. And look where the semiconductor index is. It's not a good sign. It's just not showing any strength. So that's still a very weak sector. I was asked about the IBB. I'll talk about that in the context of where we are. We only made 2 points. It had actually gone from our short of 379 down to 360. I didn't cover that, but we covered other areas, and we've made nice profits in the IBB. We've also taken little small losses. But in the meantime, back at the ranch, this is still one that I'm watching very closely. It is the go-to. It is the ever-ready bunny that fund managers have been rewarded for, and at some point that's going to fail. I don't feel any different when I said take a little bit off of your biotechs because they starting to get really toppy. And if it goes even higher, that's great. But money management says at this particular level, you got to be somewhat careful. Now let's talk about other things. In the webinar, what I want to do is to do the relationship of, at this point, what are we looking at in terms of construction, big construction, about Boston, talking about the Olympic Games, about skyscrapers. 7 skyscrapers are due to be built in a city that was really a big college town, now is becoming a big city. What's the relationship? Where are we, and how does that fit in? Is this a mega picture that says, hey, this is fantastic, we've got another 10, 15 years of growth, or is it saying we are getting really toppy? We've got to be very careful. And I'll talk about that and how we can ameliorate some of the problems that I foresee, and how at the same time we could still participate in the upside. I still say that even with a very sharp decline, we should still make higher highs going into 2016. That's been my contention for a long time. Nothing really has changed, except that I want to look in detail at the chart formations, what should work this summer, what could still work, and what will happen if we break to a new high. What's the implication? Is this like the breakout in 1994 to a certain extent? Sideways and then a breakout instead of breaking down. So I'll talk about that. And so I would consider it to be a very important seminar in the way we're looking at markets and what we need to be aware of on the downside and what we need to be aware of on the upside. And I'll talk about the financials. Where are they in this whole cycle? Have they held so well that they could lead the next move up, or are they about to break down? So thank you for being here. Basil Chapman, Tiger Technicians Hour. Don't forget, go to the front page of TFNN right there. Basil Chapman follows up on his popular 1920s webinars. And I'll be back tomorrow. Have a wonderful day. Thanks for being here.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN,